Hello, my name is Rob Newman and I am one of the partners at Carter Collins & Meyer, a firm of accountants in Rochdale, Greater Manchester, who works with owner-managed businesses, small businesses across Greater Manchester, Cheshire and Lancashire. Now, this talk is more cheery than some of my others, although it still evolves around people changing things. Because a lot of the work that we do as accountants is around the time when people change things. And today's talk is around how do you buy out a business partner? Now, let's keep it cheerful. Let's keep it as somebody's retiring. They've had a great run together. They've built this business up. They've done really well, and one of them now wants to leave because it's time for him to retire. There's a variety of ways of doing this, and this is work that I do all day long and all the time on these. And when you first come across this, it can be a little bit mind-blowing, which is why I thought it would be worth talking about how you practically do it. So, the very first thing that people say to me is, well, what's my business worth? Well, the reality of that is your business is worth what someone else will pay you. That doesn't help in the circumstances of two of you leaving, because the person leaving wants to be paid this price and the person staying wants to be paid this price. Typically, the models that are used for valuing businesses are what's called sustainable earnings. And it's a multiple of sustainable earnings. Sustainable earnings, broadly, take your accounting profit, add back those things that you choose to spend, any director's remuneration and costs that are in there, and then knock off from that the cost of taking on somebody as an employee to do the role that the person leaving has vacated. And then multiply that up, and typically 3 times. Now, if you take an accounting set of profits and somebody's on the usual salary and dividend route that most people take on these things, and you apply that formula, you suddenly find that that multiplied up profit is not actually very big. And that's actually true. Most small businesses don't have substantial valuation for their intangible assets, goodwill, customer lists. What they do have, though, is you take that and add onto it net assets or net liabilities. Net assets, though, would be the stuff you can kick and move and sell. The bank balances, the stock, the building that you own. And in most small businesses' case, that's actually where the real value is going to be. The tangible assets as opposed to the intangible assets. Now, there's whole loads of theory around this, and quoted companies and big companies are very different in the way they're done. But on dispute resolution, over and over again, both at HMRC and court purposes, and in divorces and all sorts of situations, sustainable profits multiplied by 3 plus or minus net assets. So if you own 50% of that and you come up with a number of, I've got £1 million of value there, I'm going to get £500,000, pause. Because you're not. Because a half share of something is not worth 50% of it. A full value of selling the whole thing willingly, without distress, is not the same as selling a percentage of something. Because the buyer coming in is stuck with the other person. And truthfully, the only real person who may actually want to buy it is the other person, or their family, or your children who are coming into a business. The odds of getting a third party to this are slim, which means that 50% value of £1 million being £500,000 is probably more worth 250, 300 at best, which is often a form of dispute in itself and often a reason people talk about this a lot and discuss this a lot and bring in someone like me, because when I come into this and point this out, that this is the reality of it, it's often a bit of a shock. And it's often why I would rather have these conversations earlier with people than later, because you can start looking at things like pension planning, and you can start looking at other forms of asset realizations and asset building up and wealth maintaining and creating outside of the individual business. Because for an awful lot of owner-managed businesses, their business is not their pension. So, you do agree a figure, you come up with a valuation, and you're about to leave. It's all agreed. How do you actually do it? What do you actually do? Well, broadly, there are 2 main ways. There's a share buyback, or there's a sale of those shares to a third party. So let's start with the share buyback. The company itself, the business itself, buys your share from you for that agreed valuation and cancels it, leaving your business partner as the 100% owner of what's left. Now, to do this, you have to have the right balance sheet. You have to have the right things on your accounts to show that you are actually able to do it. And it has to be approved by HMRC. So you're going to need an accountant to get what's called a tax clearance. They're going to have to value that business. They're going to have to justify the valuation of that business. They're then going to have to write to HMRC and say, this is what we're proposing to do. Do you agree? Now, the majority of times HMRC say yes. Occasionally they don't, and I've had one recently where they don't, where they came back and said, we dispute this. We don't think this is the value. We don't think this is the circumstances that you should have. In which case you are then presented with two choices. Fight HMRC or find a different route. And in almost every single circumstance of an owner-managed business I would ever imagine, I would say, don't fight HMRC. Take the alternative route, which is the alternative route of the two that I said right at the beginning. A third party buys these shares. Now, in this circumstance, it would be another limited company. It would be the other owner of the business, the other person or their family or your children or somebody would themselves create a limited company. And your shares would pass to that limited company who would then pay you by getting a dividend. Now, the reason you put another limited company in there and don't just have it as individuals is to do with the way dividends are taxed. Dividends are taxed on people, but are not taxed company to company. So if I bring Fred in and Fred takes your shares and takes a dividend out of the business to pay you for those shares, he's going to be taxed on that at up to 38%. Whereas if Fred creates a limited company and Fred's limited company takes your shares and gets a dividend to pay you your money, there's no tax. So this extra layer of complication that accountants often introduce are to save a significant amount of tax, but it does then leave legacy companies and it does leave lots of things around. Now, I've glossed over that funding mechanism because usually in small managed businesses, it is the internal value of the company, its own assets, its own cash that is used to pay for it. And that's often what people seem to not quite realize. They think somebody else is going to turn up with a big check of external capital, and it never is. It's always the assets of the company that are always used. Vendor finance is sometimes the term that's put out there. It will be the existing resources, which means if it hasn't got all that money at once, it's often going to be on the drip. And most small business sales are on the drip through vendor finance. They are a 1, 2, 3 year transaction. And at any point during that time, things can go wrong. Now, I'll cover that in another video, what could go wrong, and some of the implications of that, because it's another doom and gloom video, which is great for accountants. We often are the merchants of doom. I once heard a thing of accountants are men who come down from the hills after the battle is fought and stab the wounded. And it often feels like that because we do see what goes wrong. But sometimes some of these transactions can be funded externally. But that invariably means bank borrowings. Now, wandering into your local high street bank is not going to achieve bank borrowings today. I've not seen a bank overdraft or indeed, other than coronavirus loans, a business loan in 18 years. Since the financial crash of 2028, they just don't exist anymore. What you'll end up with is some sort of asset finance, lending against the machinery that you have, or some sort of invoice discounting, lending against the stuff that is owed to you. It will be a lot more complicated. It's not just here's a lump of cash. And again, you're going to need some form of accountancy supporting that because they're going to want forecasts and predictions and balance sheets and all these other things. But don't let it put you off. It can be done. It's readily done. I do 2 or 3 a month of these, and I'm one accountant in North Manchester dealing with 1,000 clients. So you have a range of opportunities, a range of situations and thoughts of how to buy out that business partner. But fundamentally, value the business, agree that valuation, and then talk to an accountant as to which approach it's going to be, the share buyback or the third party. Now, once you've gone through all of those, you're going to need to document it. And that's where the accountant steps aside, usually. You can do this yourself, and there are some great websites out there, things like Simply Docs. If you're comfortable with documentation and you're familiar with doing it, Simply Docs gives you a lot of precedents that you can base things around and write up documentation. Or if you're not, you're going to need a solicitor. And often not the solicitor that deals with house conveyancing. This is quite a different type of thing. Typically, it's going to be a few £1,000s, and you're going to need what's called a share purchase agreement. And you're then going to need some things around company's house, and you're going to need lots of other stuff. And I would say if you're walking into one of these, on the whole, between the accountant and the lawyer, you're probably looking at a £5,000 bill to actually have this to happen. But it allows the leaver to leave cleanly and the buyer to stay cleanly. It also sorts out the tax situation, because you can't have one of these without talking about tax. If you don't do this right, the leaver will likely be taxed under income tax and will likely end up paying 38% dividend taxes on all of this stuff. Whereas if you do it right, you can get what's called business asset disposal relief. It used to be called entrepreneur's relief. Now, it used to be 10%. Unfortunately, from April this year, it's now 18%. The joys of the current government. But at least 18% is still significantly better than 38%. And it allows the individual to have all of that cash in one go at what is still the lowest tax rate of any transactions that are available in the UK. So without this documentation and without doing this process, not only will you not have a clean setup and situation for it, you're very likely to have something that ends up with a big tax bill not done in the right way. So there's a lot of stages in buying out a business partner, and there's a lot to think about. And it's one of those things that you really need to start planning 1 or 2 years before somebody actually does. And I would say to anybody watching this, if you have a business partner relationship, quasi-partner, somebody that works with you, you should have this talk fairly regularly of what does the future look like. It should be a once a year thing, even if it's in Costa Coffee over a brew, which is always one of my best places to have any sort of business meeting. Because if you do ever want to talk to me, Rob Newman from Carter Collins and Meyer, one of the best ways you can do it is invite me to Costa. Thank you so much for listening. Really appreciate it. Rob Newman, Carter Collins and Meyer, working with businesses across Greater Manchester, Lancashire and Cheshire.